Greetings from India Business Insights. Today we are going to look at the largest of the new private sector banks founded post-liberalization of the bank licensing policy in India, HDFC Bank. It is one of the largest companies by market capitalization. It is just behind Reliance Industries Limited and TCS in terms of market capitalization and is much bigger in terms of market capitalization than its much bigger PSU rival, the State Bank of India. We will look at how it evolved, what are the reasons for its success, and where is it going forward. Before we go any further, I would like you to like and share this video and subscribe to our channel. Also remember to press the bell icon for the notification. While India had a highly evolved system of money transfers and letters of credit even in historic times, the history of India's modern banking system dates back to 1770 with the establishment of the Bank of Hindustan in Calcutta. Since then, the country saw the establishment of many banks, some of which survived, while some failed. At the time of independence, almost all the banks in India were privately held. These private sector banks were often accused of serving primarily the big businesses, which also owned these banks. To ensure that the benefits of banking reached wider sections of the population, the government of India under Prime Minister Indira Gandhi decided to nationalize 14 large banks in 1969. Later during the emergency, a few more banks were nationalized. Post-nationalization, these banks expanded their branch networks all across the country, particularly in rural areas and in previously unbanked regions. While the general public felt more secure in depositing money in government-owned banks, the nationalized banks became bloated with too many employees. Their working style became increasingly bureaucratic and inefficient, and their unions were against computerization and modern working methods, coming up all over the world. There were also widespread accusations of corruption. After the first wave of economic liberalization in early 90s, so in the mid-90s, the government and the RBI decided on allowing new private sector banks. This was intended to bring modern management and efficiency and also promote growth in the economy. On 22nd January 1993, the Reserve Bank of India released guidelines for issuing licenses for banks in the private sector and granted in-principle approvals to 10 private sector banks. Among all the banks so established, HDFC Bank was amongst the first to receive an in-principle approval from the Reserve Bank of India to set up a bank in 1994. It received its license in 1995. HDFC Bank was established as a subsidiary of the Housing Development Finance Corporation. HDFC Limited was India's largest housing and financing NBFC, that is non-banking financial company, which till date has 25.7% ownership. Thus, even though newly established, it had a strong pedigree. Today, HDFC Bank is ranked as the 10th largest bank in the world in terms of market capitalization. It is also India's largest private sector bank by assets and has a nationwide distribution network of 6,378 branches and 18,620 ATMs in 3,203 towns and cities. It is one of India's premier bank, providing a wide range of financial products and services to over 43 million customers. After attaining its license in 1995, it launched its first IPO of Rs 500 million. On listing, the shares of the company quoted at 300% premium. The bank was profitable from the beginning and enjoyed the confidence of the stock market and the investing community. It continued to grow in market capitalization at a rapid rate. Since the attainment of license by these banks began the new generation of private sector banks. While 10 private sector banks received the license, there are 7 new generation private sector banks in India: HDFC Bank, Kotak Mahindra Bank, Axis Bank, ICICI Bank, Development Credit Bank, IndusInd Bank, and Yes Bank. Thus, you must have noticed that not all banks so licensed at that time managed to survive as independent entities. Some of the weaker banks were merged into stronger banks. In February 2000, HDFC Bank merged with the Times Bank. It was the first merger of the two private banks in new generation private sector bank category. Further, the year 2008 saw one of the largest mergers in the financial sector in India, with HDFC Bank's board approving the acquisition of Centurion Bank of Punjab for Rs 95.1 billion. Collectively, it spread a network of 1,148 branches, the largest in the private sector. So, what were the factors that allowed HDFC Bank to be profitable, grow rapidly, and acquire other banks that its much larger PSU rivals or even the new private banks were not able to? The erstwhile PSU banks incurred huge costs in branch expansion, often in unviable areas. They had large staff and did not invest in technology. They also faced resistance from the unions in changing their working methods. HDFC Bank, with its good position in market capital and some other factors, was able to deal with these factors in a much better way than its competitors. HDFC Bank ensured that they established branches only in premium localities, thus these branches were better off and were doing more businesses. The bank involved more field agents, particularly for opening accounts. They were one of the first banks to send these agents to the customers' houses with Polaroid cameras to help premium customers open accounts. The bank was able to invest in technology, as a result of which it saved cost on high salaries of employees and improved efficiency. Since HDFC Bank invested in the latest technology and improved its working, it was also able to link and consolidate all the accounts in various branches. Offering this feature, it became a preferred bank for the corporates for its superior cash management systems. HDFC Bank also had a good position in terms of its CASA, that is the current account saving account deposits. These are low cost and a major source of funds for the bank. They were able to build CASA deposits faster than the other banks of the time. HDFC Bank in its initial days focused on working capital loans. It did not immediately begin providing long-term loans. In terms of housing loans, it left this niche for its parent HDFC. Even in terms of corporate lending, it restricted itself only to the good companies. So it avoided the mistakes that some of its other private sector contemporaries made initially. HDFC Bank has had a strong stability in its top management. Thus, HDFC Bank was able to garner all of these advantages and thus came up to a much better position than its contemporaries. HDFC Bank has greatly encouraged the use of various cards and has thus offered various benefits to its card users. In 2004, the bank became first in India to offer credit cards in over 100 cities. As per June 2022, HDFC Bank has 1.76 crore active users and is the largest card issuer in the country. In December 2020, RBI imposed a short ban on HDFC Bank, prohibiting the bank from onboarding new credit card customers in India. This ban was lifted last year and HDFC Bank was once again allowed to issue new credit cards in the country. Notwithstanding this ban, HDFC Bank has been the largest credit card issuer in the country. As of June 2022, HDFC Bank has 1.76 crore credit card users, followed by SBI with 1.4 crore, ICICI Bank 1.35 crore, followed by Kotak Mahindra Bank, Citibank and Bank of Baroda with 38 lakh, 25 lakh and 13 lakh respectively. As said earlier, HDFC Bank has always been ahead in the game because of its investment in latest technology. It has thus always enabled HDFC Bank to make innovative moves in a number of avenues. HDFC Bank allowed the launch of IRA, its interactive humanoid, at the Kamla Mills branch in Mumbai. It aims at helping the banking staff in serving the customers. In 2021, HDFC Bank successfully integrated its virtual assistant Eva with Alexa, making it the first bank to offer voice banking experience on the platform. Eva has also been integrated with Google Assistant, making it available on millions of Android devices as well as on Google Home. Has HDFC Bank's quest to provide a technically sound banking system been achieved? Well, not really. There have been repeated tech outages, thus questioning its technological capability. In December 2020, following a series of digital outages, RBI barred it from new digital launches until the existing tech problems are resolved. The December action from the RBI was supposed to be a strong warning for the new management to get the technological capabilities ready and avoid further slips. This restriction was lifted by the RBI on March 11, 2022. HDFC Bank pulled ahead of its much older rival ICICI Bank only a few years ago. As we can see by the figures, today it is much bigger than ICICI Bank and its other rivals, both in terms of assets as well as in terms of reach. According to the financial statements of the bank, HDFC Bank has regularly reported strong growth in profits consistently over the 25 plus years of its existence. It has a strong balance sheet and has adequate capital adequacy without much dilution in its equity in its 27 years of existence. Peer comparison in terms of ratio analysis shows that HDFC Bank has regularly maintained very high net interest margins and yet at the same time maintained a very high portfolio quality. Its NPA ratios have been consistently lower than its peer group. On 4th April 2022, the Board of Housing Development Finance Corporation adopted a composite plan to merge HDFC into HDFC Bank, as well as the plans of each entity's shareholders and creditors. HDFC's affiliates and companies will move to HDFC Bank. The proposed merger was approved by the BSE and NSE stock exchanges on 2nd July 2022. As a result, at the effective date of the scheme, existing HDFC shareholders will own 41% of HDFC Bank and public shareholders would own 100% of HDFC Bank. The total advances made by HDFC Bank and HDFC as of December 31, 2021 respectively were Rs 12,68,863 crore and Rs 5,25,806 crore. Projected financial total advances for the merged firm after the merger was anticipated to be Rs 17,86,669 crore. The amount of exposure that HDFC Bank has to unsecured loans will decrease as a result of the proposed deal. The combination is anticipated to strengthen HDFC Bank's capital base and give its balance sheet more resilience. A story about the bank would be incomplete without a mention of its recently retired CEO and MD, Mr. Aditya Puri. Throughout the years, the growth numbers achieved by the bank have been greatly credited to the team led by Mr. Aditya Puri. He was the CEO and MD of the HDFC Bank. Under Puri's leadership in 26 years since its inception, its market capitalization increased to over 6 lakh crore, making it the largest bank in India by market capitalization. During his tenure, the bank handsomely rewarded its investors, where between 1996 and 2020, an investment of 1 lakh in HDFC Bank grew to roughly 3 crore 26 lakh. He picked up the positive aspects of many international banks, such as the Wells Fargo and Company, and implemented them in the bank. However, an aspect of his vision that was his own was the understanding the sensitivity of India's requirements. He officially stepped down from the position on 26 October 2020. His successor, Sashidhar Jagdisha, has also been a part of the bank since 1996. Almost all the senior management have been with the bank for over 2 decades or more. Over these years, HDFC Bank has been one of the most prominent private banks of the country. This is greatly a result of bank's objective to build strong consumer franchises across a variety of business sectors in order to become a top provider of banking services for its target retail and wholesale client segment and to generate a healthy rise in profitability consistent with the bank's risk appetite. The bank's first objective is maintaining good client relations, and it is dedicated to doing so while following the greatest standards of morality, integrity, corporate governance, and legal compliance. The primary business strategy of HDFC Bank is to continuously create new services and technologies. According to the business strategy of HDFC Bank, one can increase its market share in India's developing banking and financial services industries by adhering to a disciplined growth plan that emphasizes quality over quantity and offering top-notch consumer services. The numerous awards and recognition received by the bank over these years also adds up to the trust among its consumers, making it a highly preferable bank. HDFC Bank won the title of Best Private Bank in India at the 2021 Global Private Banking Awards. The Best Bank in India title was given to HDFC Bank at the 2021 Euromoney Awards. HDFC Bank is ranked first among mass affluent banks under the Euromoney Private Banking and Wealth Management Survey 2021. Besides these awards, HDFC Bank has also attained a good reputation with respect to its CSR. It was honored by the Ministry of Corporate Affairs at the first National Corporate Social Responsibility Awards in 2018. It seems to have put behind its recent issues with its credit card and complaints about its online banking. HDFC continues to grow faster than its peer group and is likely to maintain its leadership amongst the private sector banks and also continue to catch up with its much larger PSU rival, State Bank of India.